I have the pleasure of welcoming you. For those of you that I haven't personally met, I'm Andrea Reeder, and I am the campaign director at Asante Foundation. And I am just so delighted to see all of you here. We have a really interesting topic that I'm excited to learn about right along with you. This Women, Wisdom, and Wealth is a new year, new plan for a bright future. And we're going to be learning about the changes expected in tax laws for 2021 and how we can plan our charitable giving and contributions while maximizing tax benefits, regardless of what we're choosing to support or which organizations we're aligned with. So this is going to be really interesting. For most of you know, Women, Wisdom, and Wealth is a program that Asante Foundation put together and we host in order to bring financial education to women along with social interaction, all with the intention of enhancing our philanthropic intentions and impact. So our Zoom platform has been interesting to learn, and we're getting very techy and getting a little bit more comfortable, but it's allowed us to extend our invitations. So welcome to those of you who have been regular participants, and then welcome to those of you who are maybe joining us for the first time today. So before we get to our main guest speaker, I wanted to just share a little bit about Asante's response to the wildfires this past September. So we've had some inquiry about how Asante is supporting the community as it relates to the fires. So were you all here? I know some of us have homes in different areas. Were you all here during those fires?
Yes.
Yes.
Yes, okay. So I'm sure that we were all impacted one way or another. It was a very scary time for a lot of us. I know that my husband and I, who are in Central Point, evacuated twice. And so it was right there at that Central Point exit. And so we had all of that excitement like many people, but did not have long-term ramifications like so many did. As you know, we had nearly 3,000 structures lost in those fires. And there were 135 Asante employees displaced. In that 135, there were 81 employees and their families who lost their homes. And so it really was devastating. And I think, I'm just going to take a minute and welcome Peggy. Peggy, thanks for joining us.
Sorry, that's late as usual.
No, I'm just so glad you're here. Welcome.
Thank you.
Yeah, so I wanted to share that Asante Foundation pivoted the campaign, Asante Forward. So we, in response to the most urgent needs in our community, we pivoted our focus on our campaign to the focus on supporting those who were impacted by the fires. And we started a wildfire compassion fund. I'm going to share with you something that our marketing manager put together for us. Can you all see that?
Yes.
Yes. So let me share this with you. So we opened up a wildfire compassion fund, and I think what's interesting to think about this is we work with a lot of philanthropists and donors throughout our community to have impact typically in some area of healthcare, whichever is most important to them. But a lot of folks in our community were looking for a trusted partner to be able to give funds to support those who needed it, and they turned to us. And we raised, you can see there, $233,000 from 371 donors from 26 states.
Wow.
That's impressive.
Including the UK. So as I mentioned earlier, 135 employees and their families were impacted significantly. Not all of them lost their homes, but they were removed from their homes for a long period of time. Here's a really great map that shows you where all of those gifts and support came from. And some of these happen because their children work at Asante, or they used to work at Asante, or they used to live in our community. But when they heard about the fires, they wanted to help. And they turned to us to do that. So that was a very scary time. It was a difficult, and it still is difficult for a lot of folks. But we felt very privileged to be able to be a source for impact for folks who just were compelled to help and needed an avenue to do that. In addition to starting this compassion fund for these folks, our Asante decided to go really far beyond and help those folks who did not have a home to return to. And so they quickly established an RV park across from the hospital, and they purchased RVs. And I believe there are 14 RVs at that park, and these are offering temporary housing. And we believe that could be anywhere from 12 to 18 months. And what this is doing is allowing these employees to have a home for themselves and their families and be able to come to work and not have that weight on them. And so some of these funds, these compassion funds, went to support that, that project. And I have to tell you, that community around the RV park has been incredibly graceful. Not everyone wants that in their backyard, but they understand that it's temporary and it's really, really important in supporting them. So I wanted to share that with you. I also want to share with you some, let me share my screen again. I wanted to share, I want to, and I'm looking for it. Let me see, there we go. All right, can you see that sign and that photograph? All right, so these are some photos from that RV park. Oh. This just shows we may not be thinking about this every day. Our lives have, for the most part, probably returned to normal, but these folks who lost their homes, they are still putting their lives back together. So beyond the RV park that Asante put together, they also put together a group of volunteer employees to form a Hands and Hearts group to wrap around these families. And one of the things that they took on was providing support, gifts, funds to buy their children Christmas presents to celebrate the holidays. And so this is, Harry and David donated these small Christmas trees, and they were delivered to these folks that are living in the RV. So it does make me think about our charitable giving and about philanthropy. And we often talk about what can philanthropy do. It can do so much. It can support, it can educate. And here I think philanthropy is healing. It is healing these folks who have been impacted so directly by these fires. So it just shows that we can have tremendous impact in all kinds of areas, whatever we are most passionate and interested in. So before I introduce and turn it over to our guest speaker, I just want to see if there's any questions about any of that I talked about, the response to the wildfires.
Yeah, I have.
Yes,
Is that okay?
yes, please.
Yeah, I was just wondering, you mentioned that the community surrounding the park was pretty much welcoming the establishment of that RV park. Is there a sense of community that's developing among the inhabitants, among the trailer, the people occupying the trailers?
Yeah, interesting. I think that's a great question. And I haven't heard any, any stories about that, but I sure would imagine that that would be the case. And I would certainly imagine it would happen more and more as the weather gets nicer. So we were just the recipient of a significant grant for $70,000 to support victims of the wildfire that were employed at Asante. And one of the things that we're looking at doing is helping them create some outdoor space outside of their RVs for the summertime, so we can have some chairs. And you know how, for those of us who do RV camping, we know how we like to have that set up, and they need to have that set up on a little more permanent basis so they can enjoy the summer. So I would imagine, I don't know for certain, Patricia, but I would certainly imagine they have to be forming that camaraderie and that connection, especially since they've all been going through similar experiences.
Right. Maybe a garden, a community garden, some vegetables or whatever, a fire pit, if it were safe, something to bring them together. Although their experience is enough, I'm sure.
I love the community garden. I'm going to check in and see if anybody has thought about that, because that would make a wonderful addition. I am going to point out to you that there is a chat box. So during any of this, you can use that for comments and questions. And I can see Simone has put a couple comments in the chat box.
Andrea, I think it's worth adding, when you talk about philanthropy being healing, what comes to my mind too is that also giving is healing, especially when our community has experienced what it experienced. And so the privilege of being able to give back and do something to help is also part of our collective healing. So I like that you pointed that out.
Yeah. All right, well, it is now my pleasure to introduce our guest speaker. Valerie Sasaki is a tax attorney and partner with Samuel Zulin Cantor in Portland. And she had her education at Tulane University of Oregon Law School of Law, and received a Master of Laws in Taxation at University of Washington. Valerie actively volunteers and serves on the board for Junior Achievement of Oregon. She teaches a Master's of Tax program at Portland State University and serves as an adjunct professor at University of Oregon School of Law and Portland Community College. As you could probably guess, with all of that, she has received numerous awards, including Oregon Super Lawyer in 2020. So I am going to turn it over to her. Welcome, Valerie. I thank you for taking the time to be with us today. When I first read your bio, it struck me, and I was taken with your volunteer service, mentoring young people. And I would love to hear a little bit about that before we jump into the topic.
Sure. So, oh, it's echoing. I don't know why it's echoing.
We hear you just fine, or at least I do.
Okay, great. So I was actually involved. So I got very interested in financial education, actually, because I was involved with our local program called Minds Matter, where they take low-income high school students and pair them with young professionals. And the idea is that you model how do you apply for college and all of these things that are not in their cultural dialogue, because their family members were not college graduates. They're first generation college attendees. And so I joined, I was mentoring two girls at the time, both at Benson High School. One of them she was the older of two kids, and her mom was a single mom, and she made $16,000 a year working 3 jobs. And so, you know, she didn't have a lot of time to dedicate to her kids. And so it was a good program because Phoebe was super, super smart, really motivated, and is actually working in Los Angeles now with a real estate company. But, you know, so Phoebe was college trajectory. So we went to the a university visitation here in the metro area. And there were kids there who at the time had their hearts set on going to the school. And they went on the campus tour, and I sat with their parents in the financial aid presentation, and a lot of these families hadn't saved anything towards college because they didn't know how. And so they're going to have to start, you know, learning about borrowing money and things like that. And I thought, well, gosh, we really just need to think about how do we fund education? What do we support in our communities and things like that? So that aspect of things is very important to me. And, you know, philanthropy has a big role to play in that, obviously, because it's how do you fund people whose passion is getting out in the community and doing those activities. So, you know, I'm not on the board of Junior Achievement currently, but I am on the board of the Japanese Garden Foundation. And I believe very strongly that we need to support the things in our communities that we want to continue to exist. And, you know, one of the most rewarding things that I get to do in my day job is to help people figure out, you know, what do they really want to support, and what is the best way to go about doing that. And so we'll talk a little bit about that today, and about some of the tax stuff that makes it, you know, extra beneficial for families to consider these things. But, you know, I really do appreciate the invitation to speak with you all. I'm excited to be here. And I think the technology is so interesting because here I can sit, you know, in Tigard outside of Portland and talk to all of you in Southern Oregon. And we could just have a really nice conversation about this. So I have some slides, but I hope everybody was able to access the chat okay. If you weren't, shake your head, because you know, I have slides, I have things that we can talk about, but I'm happy to go wildly off course too, if someone has things that they would prefer to talk about. Okay. And I think once I start sharing my slides, if you want to chat, you can actually still click on the chat box and have it pop up. So you can see the questions that everybody is asking, because I want to make sure that this presentation is useful for you. You know, I know what we talk with our clients about, but you may have different concerns and different specific things you want to talk about, and that's absolutely okay. So I'm happy to go wherever you guys want to go on this. Okay, so shall I start sharing my screen? Let's do that. Okay, share. And then we do a slideshow. I'm teaching this term, and my students are so much better at me than with the Zoom. And so it's been fantastic for me to learn from them too. So I don't think I can pull up the chat box. So if questions come up, will one of the Asante folks ping me and just say there's a question?
Yes, we can do that.
Great, thank you so much. Yeah, it's not often that I get an introduction where somebody is super excited to hear about tax stuff. So that makes me even happier to be here. So I thought what we'd talk about today is, you know, where are we coming from? What is the current landscape that we're confronting? You know, where are we now? And then we can talk about the way that tax planning and estate planning can overlay with philanthropy, because I think there's a lot of really interesting opportunities in 2021, particularly, that where we're going to be having some discussions with clients, particularly clients for Oregon residents, but clients in general, about what their philanthropic goals are and what their goals for their family are. And so we'll talk about the where do we go from here at the end of the presentation. Okay, so going into 2020, so in 2010, they had this thing called the Tax Relief Act. And what it did was it introduced this idea of portability. So there is an amount of money. So everybody during their lifetime has an amount of money that they can give away to anybody that they want tax-free. And that is your lifetime exemption amount. And if you don't use it all, then you can say, okay, well, I only use this small portion of it and then I pass away and my spouse my husband can say, okay, well, I'm the personal representative for my deceased wife, and I'm going to do what we call port. And that means take that leftover exemption and add it to his exemption. Because in our society, we really view families as economic units, as a single economic unit. And so the idea is that we want people to be able to take their assets as an economic unit and give them to whomever they want at the end of when the economic unit ends, when the second spouse dies. So that's when that came about, 10 years ago, 11 years ago now, in the Tax Relief Act of 2010. But it's something that has gotten so much supercharged in, as we've moved through since then. So in 2017, Congress, so it's called the 2017 Act, but really it's the December 32nd, 2017 Act, because they passed it on January 1, like in the early hours of January 1, 2018. So if you were to know a tax lawyer, they were probably not watching the ball drop in Times Square. They were probably watching C-SPAN to see if this thing had enough votes to pass, because we're cool like that. But anyhow, so this Tax Cuts and Jobs Act passed, and what it did was, one of the things it did is it increased the standard deduction that we have on our personal income tax returns. And so, they made a lot of changes to what we can put on Schedule A. So, those of you who pay a lot of state income tax, or even pay a moderate amount of state income tax, you can only deduct $10,000 of that now, which has been horrible for my personal tax bill. But, so they put a cap on that. And so we moved from a society where 30% of people filed a Schedule A and did what we call itemize their deductions to a society where only 10% of people did, because the new exemptions, the new personal deductions were so high. The new standard deduction was so high that it didn't make sense for people to fill out Schedule A. And so there was a lot of concern, actually, in the charitable and philanthropic community about what this would mean, because the deduction for charitable contributions is taken on Schedule A, right? And so if people are no longer having to make that outlay to get the benefit of the deduction, a lot of us who work with nonprofits were concerned that people wouldn't be incentivized by the tax benefit as much, because so many fewer people, are actually itemizing their deductions. One of the other things that it did was it doubled the unified credit for estate and gift tax purposes. So we went from being able to give $5 million over the course of our life and in our estate to someone, to $10 million. And that number has been inflation adjusted ever since 2017. So currently it's $11.7 million. So I can give $11.7 million tax-free to anyone, and in my estate, and not have to pay estate tax on that. And then to the extent that I don't make that much, I don't burn that much exemption, my husband could claim port leftover to him. And if I don't have a taxable estate, he can still take that, and he can give 22.4 or whatever, $23.4 million in his estate. So, as things stand in 2021, that's pretty great. Now that applies at the federal level for both the estate tax and the gift tax. Oregon doesn't have a gift tax, and that becomes very important when we talk about what we're going to do this year. The Tax Cuts and Jobs Act also made a ton of changes on the business side of things, which if you're interested, we can talk about, but don't directly tie to the philanthropy side of things. So we're not going to talk about them as much in this presentation. Suffice it to say that we were dealing with a lot of changes for like partnerships and LLCs and things like that for folks. Okay.
Valerie.
Yes.
We had a question submitted, okay, and it says RMD last year was suspended.
Right.
Any ramification in 2021 when it's required again?
Nope. The RMD is calculated on your base, on the amount that you own at the end of 2020, right? And so they just suspended it and said, no, we're not going to make you take it for 2020, and which is good, because we saw a lot of market volatility in 2020, and there was a lot of concern that you know, the value of the people's investment accounts and IRAs and stuff when we were going into 2020 were pretty high, but then with market volatility after the pandemic started, there was concern that you would unnecessarily deplete your retirement assets by having to take them. So, you know, so they were suspended. I haven't seen anything about them being suspended again for 2021, but we'll talk about how little we know about 2021 in a little bit here. Okay. Okay, so speaking of 2020, what a year, right? It was, yeah, just when you think nothing worse could happen, worse happened. So we had natural disasters like you were just talking about with the wildfires. I think it was really eye-opening for those of us who live in the Portland area. You know, I think Southern Oregon has gotten much worse wildfires over the years than we have. And so I think all of y'all are much better prepared at what does this look like. And I was sitting at this desk watching the sky turn orange and thinking, you know, the world might be ending. I wonder if I should stop working. As you know, as the fires that were so close to the Portland area happened. You know, so that was unprecedented level of natural disasters from the Australian wildfires through hurricane season. So, and then of course we have the pandemic, which is still with us, although I'm so happy to hear about some of your members getting their vaccinations and not being able to join us on this call. I'm so far down the list that anytime anybody can get vaccinated, I'm just so excited for them. So on top of that, and I think maybe exacerbated because we had these already existing tensions in society, there was a lot of social unrest. You know, a lot of social unrest over the summer. Our office is, you know, for a while they had, some of the rioters had broken the windows on our spinny door thing that they have going into the building because we're in the US Bank Court Tower downtown. You know, and they were having to make decisions about sending people home early for the protests. And then of course we have the election season. So that was its own kettle of fish. So 2020 was a pretty awful year. And I was fascinated to see what happened to charitable giving over the course of 2020. Charitable giving, because people are amazing and continuously surprise me in good and bad ways. Charitable giving really increased in 2020. You know, in the second quarter of 2020, the Center on Nonprofits and Philanthropy at the Urban Institute released this report over the summer last year, saying that the total number of donors to charitable organizations, and this is 501c3 organizations, increased 7.2% in the second quarter. Donations of less than $250 increased 19.2%. You know, and mid-sized gifts increased 8.1% and major gifts increased 6.4%. And so I think that really reflects how amazing people are and how, you know, in a pinch, they recognize that their fellow human being actually deserves support. And so, you know, I was really touched to hear the discussion earlier about these RV parks and people being creative in their responses to these disasters. Oh, and you can get a copy of these slides. I emailed them to Simone earlier. So if you want a copy, you can have them. But, you know, anyhow, so I was just really impressed by how much charitable giving increased in response. Now, anecdotally, and what the centers, what I've heard from some of our financial people is that the focus of what charitable organizations are the recipients of these funds probably shifted quite a bit. And so they focus more on core services and disaster relief, racial justice organizations, and probably to the expense of arts organizations. You know, I know that a lot of the arts organizations in this area were really suffering and trying to do really creative things when they couldn't do their ordinary fundraisers like we would attend over the course of the year. You know, shifting to more virtual platforms and things like that to try and still reach their donors. But so that's where we saw 2020 going. Now, a huge thing for us in the tax world in 2020 and in the business world was the CARES Act. And it's the coronavirus something. It's an acronym. But what it did on the charitable side of things, so it did a lot. And, you know, it created partial above the line deduction. Because bear in mind, we know we've moved from a world where 30% of the people were itemizing to where only 10% of the people were itemizing, right? And so that 10% of the people were not able to take deductions for charitable contributions. And so with the CARES Act, what it did is it created this new thing where people who are not itemizing could still take up to a $300 per person charitable deduction for cash contributions made in 2020. And these are things like direct aid to charities and not intended to be support organizations or donor advised funds. And we'll talk about donor advised funds and what, sort of the usefulness of them as we go through this. But that was a huge thing because it recognized that charities have a huge role to play in addressing the situations that we were confronting with the coronavirus. It also made some modifications on charitable contributions. So people who are extremely philanthropic, we have some in our office, some of our clients are extremely philanthropic, where they make charitable gifts that are a significant percentage of their annual income. And prior to the CARES Act, that amount was capped at 60% of your income. So you could take a deduction on your Schedule A if you're still filing Schedule A for up to 60% of your income. But if you gave 61%, you wouldn't get a deduction for that additional percentage. Well, they increased that to 100% for 2020. And they increased it also for corporations. So corporations that make charitable gifts, for 2020, that number went up, which is great because it restores some of the incentive for people to be charitable and help out. I mean, I think one of the things for me that was a takeaway was, we really do so much more when we're all working together to get things done. So one of the other things that the CARES Act did is it created this idea of the payroll protection plan loans, which are forgivable loans that are not included in income for 2020. That forgiveness is not included in income. And they also expanded the economic impact disaster loan program, so the ADL program. And if you guys have questions about the PPP loans, I'm happy to talk about it. I've spent a lot of time over the last year talking about PPP loans. And so it's nice to talk about the charitable aspect of things. But, so that was the CARES Act. It was a huge act and it cost a lot of money, but we've never been in a situation like that. And hopefully we'll never be again. Now we have spent, as I said, we spent the last several years as tax attorneys hanging out in front of C-SPAN at the 11th hour, watching television and watching them, whether they're going to pass the new tax act and what is that going to mean for our clients, and, trying to read 10,000 pages or however many ridiculous number of pages of legislation, to try and figure out what they're actually doing. But this year, there really wasn't any major year-end tax legislation blitz. And part of that reflects the focus of Congress on the election and the transition. Part of it, I think, reflects that, they're focused on the budget and the spending side of things right now, because we are still in an economic crisis. And so, the normal discussions that we would be having about tax legislation just are not happening and will happen as we move through the course of this year. And we're going to talk a little bit about what we know. The Consolidated Appropriations Act, which President Trump signed on his way out of office, authorizes additional payroll protection plan loans and economic relief. And those two things that I talked about, the above the line deductions, so the $300 for the people who don't itemize per person. So a married couple who files jointly will get $600. It can deduct $600. That was extended for 2021, and it also extends the 100% AGI cap. So it basically allows people who are extremely philanthropic to take a 100% deduction on their personal tax returns for charitable contributions. So where are we now? So in 2020, the unified credit base exclusion amount was $11.58 million. It's gone up in 2021 to $11.7 million. The annual gift tax exclusion was $15,000, and that's the amount that you can give to anybody. So you as an individual can give $15,000 a year to whomever you like. You can do what we call split gifting, where you and your spouse can give $30,000 to one person. And so when we were working with families, a lot of times what we'll do is, and you have married couples on both sides of the equation, is you will be able to give $60,000 because you're leveraging both sets of exclusions.
Valerie,
Yeah.
just earlier, we had a question just on this very topic.
Okay.
And the question is the 15,000 annual gift limit per person cumulative?
Well, it's annual. So it's over the course of the year. So you can't give it, it's not a $15,000 one time. So let's say that you make a $10,000 gift in April and another $10,000 gift in September. The $15,000 would exclude the first $15,000 exclusion would exclude the first $15,000 of that 20,000, but you'd pay gift tax, or you would burn unified credit. So you would reduce that $11.7 million this year by the amount of that $5,000. And you would file what we call, the tax form is a 709. You'd have to file a gift tax return for gifts that you'd make. Hopefully that answers the question. If not, put something in the chat and we can to clarify.
Thank you.
Sure. So IRS, so we have a really high unified credit base exclusion amount right now. And, you know, IRS finalized regulations in saying that, okay, we're not going to claw back gifts that are made, burning that credit once if that amount is lowered. So if that amount goes down to $10 million or whatever, and you've made $11 million of gifts, you're not going to have to then recalculate your estate because, and, you know, pay gift tax or anything on that additional amount because it was appropriate in the period of time that you were making that gift. Okay. Oregon still doesn't have a gift tax. So this is very important when we're dealing with a lot of our clients and we're doing planning, because if you're making a transfer because the difference, well, let's see if I think I've got a slide. So yeah, so here we are in 2021. So our unified credit base exclusion amount has gone up to $11.7 million. There should be a 5 in front of that 8 in 2020. The annual exclusion amount is $15,000. Oregon does not have a gift tax, and the applicable federal rate, which is the minimum rate of interest that you can charge in a transaction and have the IRS respect it and not subject it to gift tax, is historically low. Like, I don't know that we are ever going to see rates this low ever again. And we'll talk about the 75/20 rate being 0.6%, but really the only thing that you need to know is that the safe harbor that the IRS has created, where you say something is like an arm's length transaction, the rates are very low on that. And that's really all you need to retain on that.
Valerie, we have one more clarifying question
Sure.
around the gifting, the 15,000.
Yeah.
So just to clarify, the question is 15,000 is per person you give to,
Yes.
or is it 15,000 you are limited to personally?
No, that's the magic of it. So it's the 15,000 per donor, which is the person who's giving the gift, and 15,000 per donee, which is the person who's receiving the gift. So if I am a married person and I am giving let's say I want to give my sister $60,000. I could, you know, and I don't want to pay any tax on it, and I don't want to burn my unified credit. So my husband can give her $15,000 and I can give her $15,000, which is 30. Okay. But then I can give her husband $15,000 and my husband can give her husband $15,000. So it adds up to 60. So you can really, it's kind of miraculous the way that math works. And it also reflects the fact that we view married couples as a single economic unit. And so let's say I'm not giving cash. Let's say that I'm giving an asset that's in my name, like some stock or something. I can give her that stock and still claim a split gift and use my husband's exemption. he has to sign off on it, so you can't do it without their permission. But it's, you can still give assets that are titled in your individual name using that $15,000 exemption.
Thank you.
Sure. Okay, so where we are right now is there's not that much in the way of federal tax proposals that have come out. We're still in a pandemic. You know, we've seen a lot about a new relief bill from Congress, and you know, aid checks going out to people who make under the, you know, a certain threshold. And I think where the Republicans and the Democrats are diverging is, you know, what is the appropriate level to target those aid checks at, to ensure that they're going to the people who really need the money, and that they're going to the people who will stimulate the economy in their communities by spending that money. Because, you know, we, as all of you have seen in the news and seen in your own communities, small business is really hurting right now. Like, I have a lot of clients and friends who own restaurants, and the restaurant situation is extremely dire right now. And so, you know, to the extent that people get money, you want people to be able to spend it in the economy to support local businesses. So that's that. We may see another relief bill. We'll see where that goes. Now, there's a couple proposals that we've seen come from the Biden administration when they were pursuing election. And one of those proposals was to drop the amount of the annual exclusion back to the pre-TCJA levels. So that was, just to remind you, it was $5 million per person. So that's a huge difference from where we are now. You know, that's 6.7 million, that's almost $7 million of difference per person that you would no longer be able to transfer in your estate. And so Oregon has an estate tax exemption right now of $1 million. And California has no estate tax. So we very frequently will talk to clients who have significant estates and who have California homes, very frequently in Palm Desert, but, you know, also throughout the state. And, you know, say, well, have you considered becoming a California resident in your later years to try and save that, you know, up to what, 14, 16% tax on your estate? And you know, the tax tail should never wag the dog here, right? These decisions should be made holistically and in a way that makes sense for your family and for, you know, your goals. But these are discussions that we have pretty frequently. So California, because of the estate tax, and Nevada because of the income tax issues, you know, we talk with people all the time about moving to. So. Okay, so the IRS is in a state of chaos, and this is the last thing I want to say about sort of where we are going into 2021. We know who the Treasury Secretary is, Janet Yellen, very experienced economist, and you know, so she's an insider. I think that was well received to have her be appointed. Chuck Rettig, who is a extremely experienced and frankly very nice tax attorney who has been very involved with the American Bar Association and the American College of Tax Counsel, which I also am a member of. He's still serving as the Commissioner of Internal Revenue. I imagine that as we move through the spring, we'll see a new commissioner appointed, but I know that the tax bar is pretty happy having him there. And, you know, they need stability at this point because the IRS response to COVID has been terrible. So they had outbreaks at the campuses and they shut down from March through September, basically. In late August, early September, they started bringing people back on a part-time basis. But in the meantime, they had trailers and trailers and trailers that were sitting outside of the service centers that they were just putting mail in. And so at one point, I heard that they had somewhere between 12 and 15 million pieces of mail that they had not opened. Which is why we have clients who electronically submitted their tax returns, who mailed a check to pay the tax that they owed, who are getting notices saying that, hey, you haven't paid your tax bill, what's going on? Because those are automatically generated. And so it's been chaos. And so any situation that had not already been assigned to someone, a human who could work from home at IRS, has just been a disaster this year. So that's where we are with the IRS. So let's talk about the overlay of tax and philanthropy, given where we know about where we've come from, okay? So we're going to talk about sort of the what, which is giving appreciated assets, the when, which in the terms of an outright gift and donor advised fund, and then we'll talk about how, because I do want to talk a little bit about charitable trust planning, because I think it's a really useful device when we're in the environment that we are now. 2021, I think, particularly if the Biden proposal to drop the lifetime exemption goes through or starts getting some traction, is going to be a year of intense giving. We are going to be so busy that we're not going to know what to do with ourselves, and we can't hire enough people to help our clients make these gifts. Because as we know, IRS has said that if the exemption drops, they will respect gifts that are made over the course of your lifetime, as long as they're done at a time when the exemption's high enough. So, so we expect clients, you know, if the proposal to drop the exemption starts gaining some steam, we expect to be doing a lot of lifetime gifting. Now, on the other side of things, you know, there's a continuing need. So Jackson County I just looked it up today, has 7,500 COVID cases and has had 101 deaths. The Washington County, which is Tigard, where I am, has had almost 20,000 cases and almost 500 deaths. So, you know, so the COVID situation still is proceeding. The vaccination news is promising, but we're still going to see this continue to be an issue. I think we're all very worried about wildfire season this coming year and what that's going to mean for our communities. It was a real eye-opener to see what happened in this community with the wildfires. And, you know, so I don't know that people are prepared for another bad wildfire season. You know, what we've also seen is we've seen a lot of non-tax motivated giving. And so I don't know about you, but I've got a lot of people have posted GoFundMes for things where it's a direct gift to someone who's experienced a catastrophic life event in the last year or so, and needs money to get back on their feet or keep their business open or to fund a funeral. So, you know, those aren't tax deductible, but people are intensely interested in helping out their fellow human beings. And so they respond to these. One of the things that we've seen for our, with some of our physician practices is they've been able to set up these direct transfer funds where you can give money directly to a medical provider to make what we call a qualified transfer. And there's a couple areas that are not subject to gift tax. I was just telling my students about this the other day. And you can make payments on behalf of someone directly for medical expenses or for educational tuition. And it's not subject to gift tax. So it's not treated as a taxable gift to the person that it's for the benefit of. So we're seeing more things like that be set up. What we are seeing and what we're likely to see a lot of in 2021 is gifts to avoid the state estate tax. So we're going to have lifetime transfers to people that would otherwise be taxable if that was in your estate, but may be subject to the federal gift tax, but won't be subject to the state estate tax. And there is no state gift tax. And so it's one of the tools that we're using to help address that discrepancy between the $11.7 million federal exemption and the $1 million state exemption, is saying, okay, some lifetime gifting may be appropriate because you don't want to have to pay state estate tax on this transfer, because what the tax is imposed on is what you own when you die. So if you don't own it when you die, it's not going to be taxed by the state of Oregon. Okay, so let's talk about the what. The gift of appreciated assets has always been a really useful tool when we're talking with our high net worth clients, because they may have stocks that they have a very low basis in, which means that what tax basis is this idea that you paid $10 for something. And that is your what we call 1012 cost basis, because tax attorneys love to talk in code sections. There was a joke that my program director used to tell, where the tax attorneys would go to the conference and they would make jokes about, oh, what room are you in? I'm in room 1031, ha 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 ha, because that's the code section that deals with like-kind exchanges, because we're nerds. So anyhow, you know, the idea is that if you gift appreciated assets to a charity, you can take a fair market deduction and the fair market value deduction of the value of that stock in the year of the donation. So let's say that you paid $10 for this stock, it's gone up to $100. If you sold it and donated cash, you would have to pay income tax on that $90. But if you don't sell it and you just donate the stock, then you don't have to pay income tax on the $90 gain, and the charity doesn't have to pay the tax on that gain because they're charitable, so they don't pay income tax, and you get a deduction for the full $100. So it's a really great tool to get appreciated stocks or appreciated assets, which may be a interest in other things like real estate, out of an estate. So or out of the gifting scenario, and generate a present deduction. You know, the deduction that you would be able to take is on Schedule A though, and we know that's changed. So timing becomes an issue. So you can elect, and we've been talking with clients about, you know, situations in which this makes sense. But what sometimes people will do is they'll say, okay, I know that, you know, I have this standard deduction available for me. So if I make $15,000 of taxable gifts in a year and I don't have anything else that would be on Schedule A, it makes more sense for me as a head of household, or, you know, $25,000 is married filing jointly, to just claim the standard deduction, right? But let's say that you do that every year. And so over 3 years, that $15,000 becomes $45,000, which is much more than any of these standard deductions. So you may elect for a couple of years to take the higher standard deduction, and then in 1 year, just make all of your charitable gifts. So it becomes a timing issue, and it's what we call bunching. The idea that you supercharge this one tax year and then take a step back into the standard deduction. And we're seeing this as a planning technique to try and marry people's tax goals with their planning goals, their estate planning and income tax goals. So one of the things that is a problem with gifting appreciated assets is that not all charities can take them. And there's reasons for this that relate to, you know, restrictions they may have on due diligence that they have to do, their ability to sell an asset. So a lot of times what we talk with clients about is, well, does it make sense to set up a donor advised fund? And donor advised funds are huge with financial institutions. Or should I set up a private foundation? And what a private foundation is it's an organization that you control, typically as a family, that, you know, basically you put money into, you take a charitable deduction for when you put the money into it. So it sort of bunches that gift, and then you distribute it out to charities over time. There's a lot of paperwork and compliance requirements with a private foundation. And so we find that for a lot of our clients, a donor advised fund, and most financial institutions these days have a mechanism to do this. You know, the Oregon Community Foundation is a great example of how donor advised funds can really be combined to create a multi-billion-dollar organization that does wonderful things throughout the state. So, you know, so donor advised funds, because they're run by these financial institutions, can take custody of these stock type assets, sometimes other assets, but they primarily focus on equities and bonds, and sort of cash equivalents, and turn them into cash for distribution. So it's basically like a managed account for so it's the fun part of running a private foundation. You tell the financial institution, here's where I want my money to go, and they do it. And in the meantime, they take care of all the compliance stuff for you. So it's a good intermediate step from the, I'm an individual who's very charitable, to I am someone who wants my own foundation. Having a donor advised fund is usually where a lot of folks end up. There was a huge outflow in 2020 from donor advised funds. So a lot of people had been making sort of minimum distributions out of their donor advised fund prior to 2020. But because of the, you know, the multiple crises that we saw in that year, last year, you know, I was talking to some of my financial advisor friends, and they were just continuously impressed, by people being charitable and making distributions from the donor advised funds to needy organizations. So, you have the ability to control the timing and the amount when you have a donor advised fund. I think we're likely to see more of the same in the first half of 2021, just because we're still in crisis. So, the final thing I wanted to talk about in this area, the sort of where are we now, is trust structures. So interest rates I talked about are very low, right? And so for a lot of our folks, we think, well, okay, we have this $11.7 million per person to play with. What can we do so it ends up being more than that when it eventually goes to the people that our clients want to receive it? And the idea of setting up something called a grantor retained annuity trust, a GRAT, is, and here I have a picture because I think better in pictures. I don't know about you, but it's easier for me to conceive of something if I see a picture of it. So here we have a donor who sets up a charitable lead annuity trust. And what that means is that it's a trust that that should be a grantor retained annuity trust. I use the same picture, but it basically pays an annuity to the grantor for a number of years. And then at the end of that set of years, the remainder goes to kids. And so it's a great way to leverage the exemption, because that remainder gift that's going to the kids, you pay gift tax on it at the year that you set it up, and it's calculated on the present value of whatever that gift is using this super low interest rate. And so I have an example later in this of what that looks like, but basically you can end up giving them a lot more than the IRS thinks that they're going to get, because they calculate that remainder gift because they think that the 75/20 rate is how quickly the assets will appreciate. So they think that the assets are only going to appreciate 0.6% every year. Whereas, particularly when you're talking about, the stock market typically does better than 6% every year, and you can put other assets into a trust like this, such as business interests and things like that. So you can do this for charities too. And this is what we call a charitable lead annuity trust. And the idea is that you would set up a trust that would make a gift to a charity for a number of years. And the term gift of the charity is that I think it's like 5% minimum per year of the initial contribution. So if you contribute $1 million, then you have to make a 5% gift of that every year to the charity for however many years. But then you can designate the remainder. And so the remainder gift to your kids can be pretty substantial, because it's figured out at that same 75/20 rate. And here's, so you can take a deduction for the present value of that when you set this up. So, so you get a charitable deduction up front for that. And then you pay gift tax, or you burn a lifetime exemption, because remember, we're in an environment where it may be logical to burn almost $7 million of lifetime exemption this year, because it may go away if the Biden proposal gets some traction. So I think we're going to be doing a lot of these this year. We've already had some conversations with folks about how to set them up, but you pay gift tax on this remainder interest that are going to the kids. So let's look at some numbers. This is a program that we have called Number Cruncher. It wasn't importing the numbers correctly. You can see it said the 75/20 rate should be 30%, which is ridiculous. But what this models out is, it says, let's say that in February of 2021, you make a gift in a charitable lead annuity trust of $1 million. And doesn't really matter what the growth rate of the trust is, but the percentage payout is 5%. So every year the charity gets 5% of that $1 million, which is $50,000. And you can designate whatever 501c3 charity that you want to receive that $1 million or $50,000 a year. The present value of that annuity interest is $583,890. And so you get a charitable deduction for that amount, right? And this is set up so they're going to get 10 payments. So you only get a little bit of discounting on that. But the remainder interest you're giving, so at the end of that term, you're gifting a remainder interest of $516,110 to your kids or whomever. But this assumes that the assets that are in that trust are only going to grow at 0.6%. And so if the assets grow at 0.6, greater than 0.6%, then your kids are going to end up with a lot more than that $516,000 when it finally gets distributed out to them. So it's a really good planning technique because you're only burning that $516,000 of annual of lifetime exemption, but you are moving money out of your estate that might be subject to tax if they are otherwise, if that number goes down, if the lifetime exemption goes down. So from a math perspective, it makes a huge amount of sense. And we'll just have to see where we go from here. Okay, so where do we go from here? I think 2021 is really a unique opportunity for you to take stock of your financial goals. So figure out, are you paying too much in income tax? Could you use a charitable deduction? Are you likely to be in a situation where you're going to have to pay Oregon estate tax if you have an estate that's greater than $1 million, $2 million if you're a married couple. But, a lot of very middle income people will hit that just by owning their own home. The property values have gotten so high that, someone who bought their home for $30,000, we had one that, the estate turned around and sold it for $800,000 not too long ago. So you can hit that $1 million really quickly and really easily on the state level, right? And so it's something to sit down with your CPA and your financial advisors and your estate planning attorneys, because everybody should have an estate plan. If you take nothing away from this, please have an estate plan. We have one intestate will this year, because a lot of people have passed away that did not expect to pass away. We've had a sharp increase in the number of intestate estates. So people who die without a plan because they didn't want to admit that death was possible. So please, 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 I beg you, please get an estate plan. It just will save your heirs and your family so much stress. Okay, so the other thing to think about is risk of audit. And I could tell you all sorts of war stories about the problems with not having contemporaneous documentation. I know that one of the things that Simone and I were talking about is, how do you keep paper organized? And so I think one of the things that she's going to be talking about is, techniques for doing that and resources for doing that. We have one audit right now for a high net worth family that it started with 2015, and then they pulled 2016 and 2017, and they just pulled 2018. And they have very, very poor records. And it means that they're going to end up paying a lot more on the audit than they would otherwise have to. I think it's also time to take stock of what your family goals are. What are your short and long-term cash needs? And that's where having a good financial advisor can really help. When we have clients who don't have a financial advisor that they're working with, particularly say at near retirement, where it becomes really important to have a concrete plan in place with someone that you trust. We have a couple folks that we'll send them to, just because it's so important to have someone to talk about, what your cash needs are likely to be. Also, are there any business concerns? We are seeing a sharp uptick in people who have done a lot of soul searching this year and thinking, it's time for me to retire, or I want to get a plan so I can retire. How do I adopt bring the next generation into my business? And then finally talking about what are your charitable goals? I think people are very generous and very willing to share what they have when they see a problem. I would encourage you to think about having a fund of money that you can use to be responsive, but then taking a step back and say, okay, that's the money that I'm going to give in case I hear about a crisis, the GoFundMe situation where, someone that and care about desperately needs short-term cash. Set that aside and then say, okay, my bigger charitable goals, here are the things that are important to me from my values and my family and their values. And here's the things that I really want to continue to support, because then you can research those things and figure out what is the best vehicle for doing it. What is your, what are your charitable goals? How do you develop, are these the best charities to donate to? and then develop a plan and implement that plan. And that may involve things like a charitable lead annuity trust. This is a year to do something like that. And so, so I would just encourage you to sit down and develop a plan. And there's some great resources out there, but having a good financial advisor can definitely help. And I think participating in sessions like this are great because it allows you to say, okay, well, here's some tools that I need to develop, or here's what I do have as far as financial knowledge. And you can feel good about that. I feel like a lot of times women don't give ourselves enough credit for the amazing things that we do and for educating ourselves. And make sure the professionals that you work with are the ones that you want to work with. I was talking with a friend of mine who was part of a national study group who realized that, a lot of women will outlive their husbands. And then within the first year after their husband passes away, will fire the financial advisor that they had been using as a couple because the financial advisor never talked to them. They always directed everything towards the husband. And I just thought, well, that's really interesting. From a customer service, a client service perspective, you want your clients to feel educated and feel like you're a team player. So if you're not feeling that from the people in your team, I think it's worthwhile to have a conversation about, well, what can they do to improve their communication, or are you with the right people? So, so that's my soapbox on that issue.
Such great information. Thank you so much. I have a list of questions here that have come through, and then some comments myself. But let's start with some of these questions, starting with just a clarifying question on the RMD. Is it likely to be forgiven again in 2021?
I have not heard anything. You don't have to take your RMD until the end of the year. And so depending on how the market does, I would probably hold off if you are thinking that you don't need it, just to see. But keep it front of mind because there's penalties associated with not taking it.
All right, thank you. Another one here. Do you think the SALT, S-A-L-T, will be rescinded?
That is a topic that is near and dear to my heart. As I was saying, my tax bill, like the amount that I lost in that deduction, I multiply it by my effective rate, and that's the check that I had to write. I was so mad. I have heard that there's a lot of pressure from blue states on the Biden administration to restore that. I'm watching it with bated breath, so we'll see. But I haven't heard anything official coming out one way or the other from the administration.
All right. Here's another one. This was the first time I learned any I bond value over 100,000, regardless of having a trust, must be probated. Any idea how to protect this part of your assets without cashing them in or giving them away?
I don't know about that specific asset. What I would do is I would talk with your financial advisor to see if there's perhaps a way to put that in maybe a better investment vehicle.
Okay. All right. Here's another question about donor advised funds. And I just might share with the group that in a way, Asante Foundation has started working with our donors in a little bit of this kind of scenario where we are working with donors to give, and then we hold that over a period of time and let them choose from year to year what they are going to designate that gift to and how much. So in a way, we're able to support some of that gifting and then giving them time. Now, of course, that's within the health arena. So it would be areas of healthcare. But we're starting to do a little more of that. So the question, are donor advised funds controlled by the donor, or do they get pooled with other donors at the given financial institution?
Yeah, and that's the really nice thing about the donor advised fund is that you as the donor have your own bucket, and your bucket is, you control what's in that bucket. I go to the Oregon Community Foundation, well, not this year, probably not last year, probably not this year, but they have a huge lunch every May, and it's my favorite event to go to every year because they talk about the cool things that people do throughout the state. And there was one retired school teacher on the coast who set up a donor advised fund with the community foundation that grew to over $1 million because of, again, the community foundation manages the investment, so they can balance out the risk and over the overall portfolio a lot more. But, that basically provided a scholarship for kids in her small coastal community to go to college. And I thought, this is amazing. So I love it. It's so heartwarming. But yeah, you as the donor control where your money goes.
Excellent. Here's a question. Did you say if married, the Oregon estate tax threshold before paying tax is $2 million?
Well, each individual gets $1 million exemption, and we don't have portability in the same way that the IRS does, but we can set up something that we call an Oregon Special Marital Property Trust that basically creates a thing that is like that defers that tax until the second death. So you can have $2 million go with some restrictions, have $2 million go tax-free if you're a married couple. If you're a single person, then you have your $1 million and that's it. And it's really low. Like Washington, the exemption is 2 million indexed for inflation. So it's like 2.2 at this point.
Very good. All right, one more question here. Back to gifting. We have a lot of folks who are considering gifting. The cumulative $15,000 gifts, do they count toward the $10 million lifetime limit?
That is
I'm sorry, can you say that again?
No, I said it's a fantastic question.
And then the second part of it is, and when gifting over 15,000 in a year, do you need to file a Form 709?
Yeah, so the $15,000 cumulative, or the gifts that you make every year that are subject to that annual exclusion do not go against the $10 million lifetime exclusion. So you apply that $15,000 first, and then if you have an amount over that, you can do what we call use up some of that lifetime exclusion. So, and then, yeah, when you gift over $15,000 in a year to a single recipient, you need to file Form 709. But let's say that I give $5,000 to my two nephews, each to my two nephews, so $10,000. Neither of them hit that threshold, and so I don't have to file the Form 709. But your CPA can handle that stuff for you too. The CPAs are usually the best people to prepare the 709s. As attorneys, we'll prepare the estate tax returns a lot of times because there's a lot of legal analysis that has to go into what the assets are and how they're valued. And so it makes sense to have us involved in that process. But the CPAs are great when it comes to doing the 709s. And some of them do the 706s as well, but a lot of them don't want to touch it.
All right, thank you. Just a couple comments. I really appreciated you sharing some of the more sophisticated, but of course a little more complicated ways of giving, including charitable gift annuities, charitable remainder trust, charitable lead trust. Those are really great considerations. We, the Asante Foundation, being affiliated with Asante Health System, which is such a strong financial organization, we are in a position to support philanthropists in doing those kinds of gifting. And at any time, we can run what we call scenarios or proposals. So if anyone's ever interested in seeing what something might look like in that scenario, similarly to what Valerie showed, we can run those for you and give you some guidance. We always defer and encourage you to talk to your professionals. We know just enough to be a little dangerous, but at least we can share that with you and help guide you through that process.
I would encourage you to start with someone like Andrea, because our hourly rate to do that is our hourly rate to do anything, and so they're not going to have to charge you $400 an hour. So.
Absolutely not. All right, so I'm going to check, is there anyone else that had some questions for Valerie? And I think I've covered all of them that were submitted. While you're doing that, I do want to share with you that organization is really important, particularly for all of that paperwork, as Valerie was sharing. And so we are going to be getting each one of you one of these. Let's see, can you see that? So this is a book called 31 Small Steps to Organize Your Paper. And so we're going to be sharing that with each of you to get started in this new year and stay organized so we can avoid all of those scary situations that Valerie commented on. But again, Valerie, it was so lovely to have you come today. I learned things. I'm sure our group learned a great deal. What an honor to have you here. We're going to open up the audio now. I don't know that we have any specific questions for you, but I do want to open it up to everyone. We can spend a little time chatting, and we'd love to hear your responses to anything that you learned today, or in general, how you're doing and what's going on in your lives.
And before we do that, I just want to say that if you're like me, things will occur to you after we end this meeting. So feel free to just shoot me a quick email if you've got a general sort of, I didn't quite understand this thing in your presentation question. You know, I'll drop my contact information into the chat so that you all have it.
Thank you.
Yeah, absolutely.
I have a follow-up question for Valerie.
Yeah.
I've heard, I get different recommendations for how long we should keep our tax records. So in the bucket of keep your paperwork well organized, what do you recommend?
Well, so the fraud statute is 7 years. So our firm keeps records for 10. That is a conservative position. What we're recommending to clients more and more now is that they scan their financial records, because then you aren't stuck with all this paper. And so it makes it much easier to keep all in one place relating to a specific tax year. So, you know, at a minimum, you should keep it for 5 years, because it's a 3-year audit period, and then with a little bit of cushion on either side. If you want to be super conservative, I would say 10, but 5 at a minimum. And
is there any, if you sold a house, a home, do you need to keep your tax records on that sale forever, or
no,
after 25 years, is that okay?
You know, when we cleaned out my grandparents' house, we found their 1950 tax return. You don't need to do that. But I will say that, you know, where the sale of a house can have an impact on your tax return is if you have claimed the principal residence deduction and excluded some of that gain. So the same rules that apply to your income tax return should apply to that. And so, you know, the idea that if you are going to be audited, then you want to make sure that you have it for the last 5 years. Now, the other thing that's interesting about that is that if you're thinking about gifting an interest in your house, or thinking about doing something like that, when you gift something, you don't get the step up in basis that you do with your estate. And so the person who takes it from you takes it with your same tax basis in it. So if you bought your house for $30,000 and you decide that you want to gift it to your kids, they're taking that house with the interest with that same $30,000 basis. So it's worthwhile to talk about, when you're talking about gifting with your professionals, what assets make sense to gift. Because if you were, so I was talking with my students about this, because they're all accounting students. And so they think in terms of numbers, right? And so I said, well, let's say that you buy a stock at $10, it appreciates to $100, and you give it away the day before you die. If you give it away to someone the day before you die, and then they turn around and sell it the day after you die, they have that $90 gain, right, that they have to pay tax on. If you hold on to it until you die, it gets a step up in basis to fair market value of $100. And then they turn around and sell it the day after you die, they don't pay any tax. So, you know, substantially appreciated assets are things that often don't make a ton of sense to gift, except to charities, because the charities don't have to worry about that discrepancy because they don't pay tax on the gain. So, so that's the only real exception I would say to the 5-year rule, is if you're thinking about gifting an appreciated asset to family, then you probably want them to know what your tax basis in it is.
Thank you.
Mm-hmm.
All
I
right.
really appreciate the opportunity to talk with you all today. So thank you very much. And thank you for your good questions.
Thank you. It
That
was
was
very
great.
well presented.
Thank you. So
Thank you.
again, ladies, just a small warning that at 4:30, this will abruptly kick us out, but I welcome you. I just want to warn you, I don't want to leave you on that note, but I do just invite you to stay. I would just love to hear from you and hear your comments on today's topics or anything else you'd like to chat about.
I'd just like to say how proud I am of Asante. Brings me to tears every time I see the paper. You've done something not only for your employees, the community, now the establishment of the center in Ashland. These types of things make it so endearing to us as part of your Asante group to know that you give from the heart. You talk to us about giving from the heart, but the entire hospital is based on that. So I just want to compliment you.
Well, thank you, and we'll share that with all of our colleagues. Is everyone aware of the new COVID infusion center that was just recently opened at Ashland? If you're not, there's quite a bit of press, and it was in the paper. It is the first of its kind in the state of Oregon, and wouldn't you know it, it's right here in Southern Oregon, and that's just because Asante, leadership is full of A-type personalities, and if they have an idea, they are going to get it done. But even just equally as important, that happened because we, similar to the Wildfire Compassion Fund, we started a COVID Compassion Fund, and right away, back last year in March, folks came forward and they wanted to help, and they didn't know exactly how to help, but they shared their charitable giving, and we put it in that fund so that it was ready to be used by leadership for the highest priorities. And it was charitable funds that we then gave for them to open that infusion center. So remarkable.
As long as you're talking to your colleagues in the hospital side also, not just the foundation. We have experienced in the last week and a half the mass vaccination clinic over in Josephine County, and the management that Asante is taking over the whole vaccination effort in Jackson and Josephine, we think is just astonishingly good. I was on a call with some friends from Chicago today and describing to them how it's working in here in our counties. And they were just shaking their heads, and they were saying, who's leading the effort there? I said, as far as we know, the face of it is Asante, and it's just remarkable. So thank you. And tell your colleagues, please.
I will definitely pass that on. I know that there are folks just working around the clock and responding it, in time, because it changes from hour to hour. The number of vaccines, the plan, reacting to pieces of the plan that are working and adapting and implementing more efficient ways to carry on. So Asante really did step up and took ownership of the management. And I agree, just doing an outstanding job. Thank goodness.
I would like
Andrea,
to. Sorry.
along the same lines, Andrea, could you address the fact that Asante now has the health center at Rogue Valley Manor, kind of how that came about? And
so when you say the health center, are you talking about the new pavilion or the vaccination clinic?
well, my understanding was that Asante had taken over the entire health clinic at Rogue Valley Manor.
Oh, at Rogue Valley Manor. So I'm not going to be able to talk too much about that. I'm not going to be the expert in that, but we did, my understanding, and Sue, jump in here and help me if you can add to this, but it's my understanding that they came to an agreement and now have a contract to be delivering healthcare at the manor fully. We know that people were already choosing to retire here in Southern Oregon because healthcare was delivered at such a high level, and now to have this kind of partnership to own the delivery of care at the manor is just another addition. Sue's my colleague here at the foundation. Is that appropriate and correct?
Yeah, I mean, it started out as Asante. They came to Asante to help manage the clinic there. And I don't have, like Andrea, I don't have all the details on now that it's open and up and running, but I think some of our Asante physician partners are going into the clinics to help at the manor. So yeah, we can get you more information on it pretty easily.
That'd be good. Patricia, did you have a question or a comment?
This is the first time that I've met Jennifer. And hi, Jennifer. And I understand you are fairly new to the foundation. Is that
Yes,
I've been out of it a little bit. So
yeah, I just started about 3 months ago. Is that right, Andrea? Yeah, a little over 3 months ago. And I was working at the Shakespeare Festival, and I live in Ashland with my husband and my 2 small children, and I'm just really honored, truly honored to be part of the Asante and part of this incredible foundation team. I don't know if everyone's aware that you truly were so blessed that this is a team of excellence and integrity, and it's just gotten better and better the longer I've been here. So yeah, and I'm so happy to meet you.
And I was just wondering, coming from the OSF, very different types of organizations, Asante and OSF, and how is your experience? What have been the biggest differences that you've encountered between the 2 organizations in major giving?
Oh, that's a really good question. I will say one of the most profound things about being at the Asante Foundation is the way in which Asante, the health system, is so well run and so well managed, and the foundation has been so successful and has continually pushed the bar. So what that allows when it comes to major gift fundraising is that the foundation is able to come alongside donors as partners and really center the donor's priority, the donor's timing, what really matters most to them when it comes to making philanthropic gifts, as opposed to, in an environment like the arts, you're trying to keep the doors open every year. And so it's a little, sometimes the needs of the organization feel like they're driving your conversation with donors. And I think it's really powerful here at the foundation that it really is about the donor and their timing, their passion, what matters most to them. And we really get to be guides and partners in that process. And that has been, Andrea's heard me talk about it many times. That's a huge difference that I really appreciate and am enjoying, if that makes sense.
Am I hearing that the timeline is quite different or somewhat different, that you're looking at a 5-10 year timeline maybe with the Asante? It does have a piece.
Or like, I think arts. For instance, with the capital campaign at Asante, it's one of the most exciting philanthropic opportunities any philanthropist in the Valley has. And I think the fact that the foundation can sort of take their time with donors, really share, okay, what are the big priorities? What impact is this going to make? And there's all these different areas. And sort of letting the conversation take real time so that you can perhaps you can realize larger, more meaningful, or maybe it's not even larger, but more meaningful, smaller gifts with donors when you're not just, okay, I just got to get in and I got to get this gift to meet the annual budget. And then next year I'm going to come back to them again for the exact same thing. And every year I'm on this, turntable, right? Whereas here it really gets to be thought out, strategic, and on a much more long-term. But that being said, I know that the foundation has realized some really great gifts in short timelines too, right? It doesn't always take 5 years or 2 years. Sometimes when the cause is right and the donor's passion and, you know, their need is right, happens quickly. So
They can set up a neighborhood.
yeah, exactly. Yeah. Yeah.
Nice
All
to
right,
see
any-
you, Sherry. It's nice to see you, Sherry. I think we didn't we work in the birthing center together?
Oh, yes, ma'am. We delivered our baby.
We did.
Okay,
That's
ladies, I
going
have
back
to,
a ways.
yes, I
That's
have to
going back a
explain
ways.
to you that these,
Yeah.
these ladies are talking about a sim lab tour, that as soon as we are post-COVID, if you haven't had a tour of our simulation lab at Asante, this is where we have computerized mannequins to use for training for our nurses and physicians, and they're amazing. They have a mannequin that gives birth. You can do a C-section, a natural birth, one that's perfectly normal, one with complications. They have a male mannequin that has heart attacks and strokes, and he turns blue and he talks and moans, and I mean, it's amazing. And so these ladies did deliver a baby and had a great deal of fun. I still have those photographs. So if you have not had a tour of the sim lab, we will arrange that for you.
It's great. We got sprayed on too.
It's very realistic.
I definitely want to experience that. I haven't gone on that tour yet.
Oh, yeah.
It's unbelievable, really, truly. What an eye opener. What a great facility that nobody really kind of, you know, it's kind of under the radar. I guess, maybe not.
Well, thank you very much. It was very, very well done.
Thank you. Thank you,
Thank you.
Valerie. Thank you, Andrea.
Lovely.
Our
meeting you all.
pleasure.
Great.
Nice seeing
Valerie.
all of you
Thank
today.
you.
Thanks.
All right, everybody. Goodbye.
Bye now.